Hello, everyone, and welcome to another Webinar Wednesday by Smartkarma. I'm Michael Tegos. Today, I have the pleasure of welcoming Alec Tseung, who will speak about the future of the brokerage sector in China as competition from emerging online brokers intensifies by looking at the historical development of the brokers in Japan and Korea. A few words about Alec. He is an emerging markets focused analyst. He previously spent time with Tencent, where he was responsible for the group's investments in overseas markets, including Southeast Asia, the Middle East, and Europe. Prior to Tencent, he was in the principal investments at Swiss Re, where he focused on driving the group's investments into the financial services and fintech sectors in Asia Pacific. Alec, thank you very much for being with us today. Over to you.
Sure. Thanks, Michael, for the introduction, and thank you very much for having me today. So before I delve into details of the presentation today, let me just give you an overview of what I'm going to talk about. So we'll focus on the retail brokerage market in this presentation because that's really where the disruption is really happening most significantly, and we'll focus mainly on the listed brokers today. So I'll first talk about the current competitive landscape of the brokerage sectors in China, Japan, and Korea. The reason I'm going to touch on the brokerage sector in Japan and Korea, even though the main focus today is really on China, is because, in my opinion, the sectors in Japan and Korea have already undergone the sort of first phase or first wave of technological disruption and competition, which is very similar to what the brokerage sector in China is now undergoing. And so I do think by looking at the development of the brokerage sectors in Japan and Korea, it can give us quite a bit of insight into the future development of the sector in China. I will then summarize the key trend in the second part of the presentation. And at the end, to wrap up the presentation, I will use two listed Chinese brokers as examples to showcase how they have been reacting to the trend. So looking at the competitive landscape of the brokerage sector in China, the Chinese brokers can be broadly divided into three categories. The first category is the emerging pure play online or mobile focused brokers, such as Futu Holdings and Tiger Securities. And as you know, both of them are listed in the US. The second category is the more established and traditional brokers that have more than just brokerage business in China, such as the giants like Tech Securities, CICC, and so on. And finally, there are the so-called hybrid brokers, which are traditional brokers, but have also been adopting technologies early on in order to defend their position in the retail market in the face of competition from the emerging pure play online brokers above. In Japan and Korea, the competitive landscape is more or less similar, but the key difference is that many of the online-focused brokers that currently dominate the retail market started way earlier back then in the early 2000s, and they represented the first wave of technological disruption for the traditional brokers in Japan and Korea today. So with more than 20 years of development, these first wave online brokers in Japan and Korea that initially started as pure play brokers have also diversified the business into more than just providing retail brokerage services. For example, Kimun Securities started as a pure play online broker in Korea and has expanded into Indonesia and also developed its own asset management and investment banking business in recent years. Similarly, Monex in Japan also started as a retail-focused pure play online broker, has also diversified its business out of Japan into Asia Pacific and the US, and also acquired the crypto exchange in Japan, Coincheck, which has been its main driver in revenue growth and margin expansion in recent years. So if we track the development of the sector in Japan and Korea over the, I would say, past 10 to 15 years, the trend is quite clear. So we first have the disruptors that are usually cheaper and more sophisticated in terms of technologies. They entered the market, they managed to gain traction in the retail brokerage sector, which then pushed the traditional brokers to focus more on institutional business instead of the prior strong focus and control on the retail market. Or the traditional brokers, they will have to catch up on the tech investments as well in order to stay competitive in the retail market. And even within the retail markets, these traditional brokers, they have to differentiate themselves, and many of them started to focus more on wealth management or financial advisory instead of just providing retail brokerage services. For the disruptors themselves, since the margin in the retail market is quite thin because of the competition they helped start, so they will have to diversify and move up the value chain gradually as well. In my opinion, we will see this trend in the brokerage sector in China as well in the coming 5 to 7 years. To a large extent, I think we're already seeing the trend. For example, when we look at Futu Holdings in China, which is one of the leading online brokers that started in 2007, it primarily focuses on providing brokerage and trading services through its digital platform for domestic investors in China who want to trade stocks in the overseas markets, particularly in Hong Kong and the US. So what's interesting to see is that it has also branched out into providing IPO subscription services for investors in 2019. I think Robinhood just announced to do a similar thing in May, but Futu is actually more ahead in terms of this development. So the IPO subscription services, or the corporate services as the company calls it, is part of the segment Others here on the chart. Futu has been a co-book runner and co-manager for a few landmark Chinese IPO deals in the overseas market. For example, last year, in 2020 alone, it was the co-book runner and co-manager for more than half of the IPOs of the so-called new economy companies in China listing in the US. For example, the IPO of the Chinese EV manufacturer, Xiaopeng or Xpeng, Ping An's fintech subsidiary, Lufex, and the online housing transaction platform, KE Holdings, or in Chinese Beike. So the reason why Futu could get allocation from these listing companies is because they have been seen as the platform that has very prime retail investor base that are mostly white-collar, affluent office workers in China who are very interested in riding onto and also investing into the success stories of the Chinese companies, usually tech companies, listing overseas. So corporate services has had strong growth, especially last year, but its contribution to the company's total revenue is still rather low at only around 10%. In the coming 3 to 5 years, so we believe that this business segment will have tremendous growth, provided that Chinese companies will continue to pursue listing in Hong Kong or the US. But at least as of now, we don't see the trend of slowing down. So in a way, Futu is already in the process of becoming a more diversified online broker, similar to what has happened to online brokers in Japan and Korea, just like Monex and Kimwoon. The other example I would like to highlight here today, before I wrap up my presentation, is Tech Securities, which has been the prime example or sort of success story to showcase how a traditional broker in China could defend its retail markets by adopting technologies early on. So Tech Securities actually adopted tech or internet initiatives as early as 2009. It first launched a mobile trading app in 2014, and because of its early adoption of technologies, its current trading app has the highest monthly active users among the traditional brokers in China. If we look deeper into Huatai's financials, we can see that its wealth management business, which includes retail brokerage, unlike the more established brokers such as Tech Securities, as shown here, actually had a pretty decent growth last year, although not as strong as the online brokers. Its wealth management margin has also been rather stable. Since I'm showing the profit before tax margin here, so I don't think we should compare Huatai's margin directly with Haitong's margin. But the key observation is that Haitong's margin deteriorated much faster than that of Huatai's, and this trend is quite clear. So when we look at the Chinese brokers, we're really in this extreme dilemma or bipolar situation where on the one hand, we have online brokers that are trading at a very rich valuation, for example, an average of 11 times price to book, obviously thanks to their strong historical growth and also the pandemic. And on the other hand, we also have some traditional brokers that are trading at 1 times book or even below book, as in the case of H shares in Hong Kong. And that's why I call it a competition between value and growth. The Chinese retail market will no doubt look very different from what we see today in 5 to 7 years, and also given the entry of foreign securities firms and also brokers. But what I also want to highlight is that it doesn't mean the more traditional brokers will go out of business or the online brokers will replace them completely. Based on experience in Japan and Korea, the online brokers have actually coexisted with the established brokers for quite some time by now. The key for those traditional brokers is whether they have the resources to either push to the wholesale business or stay competitive in the retail business. And those who fail to do that will likely be the target of consolidation in the next 5 to 7 years. So that's all I have for today. I'll open up for questions. So back to you, Michael.
Thank you very much, Alec, for this concise presentation. I'm wondering, I understand that a lot of these online brokers are actually backed by internet companies in China. Can you give us a bit more color in this? And what's the interest of tech companies in those online brokers?
Sure. So, for example, if you look at Futu Holdings, so Tencent is a shareholder in Futu Holdings with around 20% stake. for Tiger Securities, which is another popular online broker that helps domestic investors in China trade overseas stocks, is backed by Xiaomi. So Xiaomi is a Chinese iPhone manufacturer. So Xiaomi holds around 10% stake in Tiger Securities. Alibaba also invested in Tech Securities back in 2018 with a small minority stake. And through Ant Financial, Alibaba also invested in a smaller private online stock trading platform called Snowball in Chinese Xueqiu. So which actually started as an online financial blog, but then somehow branched out into providing online trading services for its readers. So I think the reason why technology companies are very proactive in pushing into online brokerage is similar to why they have been so active in pushing into fintech or payments industry, at least before the regulators warning last year. So on one hand, it helped these technology companies enrich their ecosystem as it caters to more scenarios and needs of different users, and users will spend more time staying within the ecosystem, which could then help solidify the ecosystem's super app status. Right? On the other hand, it's also a great way for the tech companies to monetize from the users. At least for now, I don't think any tech companies have the license to provide brokerage services online. And so I think that the best way for them to do is to invest in those upstart online brokers and then incorporate their services into their own ecosystems. Yeah.
Got it. Thank you. As a bit of a follow-up, we saw how regulators basically crack down on a lot of those fintech plays, as you just mentioned. So do you think that we could see similar, I guess I'll call it crackdown, on those online brokers as well? Or do you expect it's going to be a kind of different environment, also given those recent developments?
Yes, sure. So I do expect it will be a bit different, at least looking at the domestic brokerage sector in China, right? So what I want to highlight is the brokerage sector itself is regulated already. So whether you're an online broker or not, you still need a license in order to provide brokerage services. But I think the risk is higher for companies like Futu, because I want to highlight that so Futu doesn't have a brokerage license in China because it claims to provide brokerage services in Hong Kong and the US, and that's why it only has license and regulated in Hong Kong and the US. So Futu claims that it is only providing technology and also R&D activities in mainland China, and that's why they don't need the license, right? But it's quite clear to most people that Futu is helping domestic Chinese investors investing in overseas stocks, right? So whether those activities constitutes providing brokerage services, I mean, we can debate that, but at the end of the day, the regulator will decide, especially judging by the fallout of Ant. But I think the risk is definitely higher for companies like Futu because they're operating in this gray area. And so I think one possibility is that maybe the regulator might ask people in China to open the brokerage account within China, because right now how they do it is that they will apply online and they don't have to come to Hong Kong. So I think that's one way they can bypass the regulation. But one day, I think the regulator might insist that they have to open the brokerage account within mainland China.
Understood. We have a question from the audience, which is basically asking for your highest conviction long idea at the moment. Can you share that?
Sure. So within China, I would say those online brokers have very strong growth potential, and I would prefer those online brokers to the more traditional ones. My personal opinion is that it's always better to be the disruptor than being disrupted. Right? And then if within the region, if I look at Japan, Korea, and China, I think Korean brokers are quite interesting. I think one idea is Tencent Securities. So the company is an online broker in Korea. It started in early 2000s. So it has 20 years of operations experience. It has 30% market share in the retail market. The company is trading at 1x book, but the return on equity is around 27%. So for me, I think that really offers a lot of value. And given the high ROE profile, I think that is just very attractive to me. Yeah.
Got it. Thank you. Do you see a similar trend in Japan and Korea, where internet companies, tech companies are trying to kind of push their way into the online brokerage sector? And what are kind of like the main differences you see between those countries and China?
Yes. So definitely, I do see a similar trend going on in Japan and Korea. For example, in Japan, the mobile messaging app Line has partnered with Nomura to launch Line Securities, I think back in 2018, which provides sort of mobile-focused brokerage services. Similarly, in Korea, so the fintech winners of Kakao Pay, also launched Kakao Pay Securities that target young people or investors without much financial knowledge. So I do see that there is a similar trend going on. The key difference is that these new online companies or brokers in Japan and Korea, so their focus is more on the young people without much financial knowledge or investment experience. Because if they're not so young, or if they have more experience in investing, then they probably might be already trading with existing online brokers that started in early 2000s. Right? But in China, it's quite different because the first wave of technological disruption didn't happen in China. So the potential markets and the users for the new online brokers are much wider and deeper than those in Japan and Korea. I think that's the main difference. And in a way, I think that's similar to the reason why online payments is so popular in China, because credit card never became popular in China. So there's not so much inertia in switching to online payments from credit cards as compared to the people or the users in more developed countries like Japan and Korea, or even Hong Kong.
Thank you for that. I guess in the US, speaking of Robinhood, which you mentioned earlier in the presentation, of course, we all saw the developments with game stonks and how the Reddit communities kind of got into trading the GameStop and AMC shares. Do you think we could see similar trends developing in basically the Asian markets that we have just looked at,
Yeah,
or is it
yeah,
kind of a different environment?
yeah. So I think so I think we're already seeing that in Korea, right? As far as, I mean, I understand that I think a lot of because of pandemics, a lot of retail investors in Korea that have been actively participating in the stock market. And also, if you look at the stock market in Korea, I think they have been doing extremely well last year and also this year. I think Korea, Taiwan, and Vietnam, I think these are the three best performing markets in Asia this year, thanks to the retail investor frenzy. Right? I think people in Korea, they call them the KNs, right? So I think it is already we're already seeing this trend in Korea. In Japan, is less the case. I think it's also less the case because of the regulatory the regulatory control, right? So
Makes sense. When speaking about Futu and Huatai securities, what you've described, what you've highlighted, I guess can be broadly considered as their investment thesis. What about the key risks and concerns there? We've talked a bit about the regulatory environment, but is there anything else that you think investors should be aware of?
yeah, I think so for Futu, I think one significant risk is valuation. So as you can see from the slide here, online brokers they're trading at a much richer valuation as compared to traditional brokers or hybrid brokers. We can debate if price to book or price to earnings are the right way to value these online brokers, but I think the bottom line is the valuation is quite rich. Right? We could switch to price to sales to value those brokers, which is similar to valuing technology companies. But then, in any case, I think compared to those traditional brokers, their valuation is quite rich. For Futu, for example, the share price has increased by I think 600% since June last year. So in any case, I think the valuation is quite rich. The other risk, as I highlighted, is the regulatory risk in China. For Huatai, I think so. Huatai being the prime example of the hybrid broker. I mean, the positive thing is that it has a good online and offline presence, but then the negative thing is that it's being stuck in the middle. Right? So it's getting squeezed by both the online brokers in the retail market and also the more established brokers in the institutional business. And also, as you know, the entry of the foreign securities firms and also foreign brokers into China, which has been going on since last year. So I think those foreign brokers, they would create more competition for companies like Huatai as opposed to online brokers, right? So I think that will be another key risk for investing in companies like Huatai.
Got it. Thank you very much. Well, if there aren't any more questions, I believe we can wrap it up. A bit of a shorter and sweeter session this week. Alec, thank you very much for sharing your insights with us. Please note that Alec is available for bespoke research requests or premium services. So if you want to engage him for that, please do contact your Smartkarma account manager and they will be able to help you out. And Alec has also written a detailed Smartkarma original insight on this topic, which I encourage you to seek out and read. If you have any other questions or comments, please email us at research@smartkarma.com. Thank you, Alec, once again very much. And thank you everyone for attending.
Thank you. Thank you, Michael.